Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Welcome to the Live Squawk preview show. Today we are here to discuss predominantly the US inflation data out later on today, but we'll also take a look at the UK and all things related to the UK at the moment. We saw inflation data out this morning, which is obviously of interest, and also we'll have a look at what the effects of this will have on monetary policy and fiscal policy moving forward. So thank you for joining, and we'll get straight into it. Anyone who's new to the Live Squawk, we are a financial audio news stream. We are 24/6 effectively, and we bring you all, and we aggregate the news, financial news, and bring you all the market and relevant geopolitical news straight to your desktop through our browser app. So please take a look at livesquawk.com and see if it's something that you might find useful in your trading day. Also, we'll get the boring stuff. I'm joined actually by, they're not boring at all. Actually, they're quite funny together. They should form a double act. But I'm joined by two market experts and strategists out there, and I'll introduce them in a second. Before I want to do that, though, I'll just quickly go through a disclaimer here. The content provided on this channel is for the informational and educational purposes only. I am not a licensed financial advisor, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in the financial markets carries risks, and past performance is not indicative of future results. Neither Live Squawk or myself are responsible, or my guests responsible for any losses or gains that may result following the content on this channel. Now I've got that out of the way, I'd like to introduce Ryan Littlestone of Forex Analytics and Michael Brown of Pepperstone. Michael Brown is Senior Research Strategist at the broker platform, and Ryan trades for himself, but is also a strategist and commentator, market commentator for Forex Analytics, as well as Forex Flow as well, his own platform. So welcome to you both.
Afternoon, mate.
Very good afternoon.
Afternoon.
You mentioned double acts. I'm wondering, what are we? Sort of two Ronnies, Morecambe and Wise. Where are we going with that one?
I was going to say, yeah.
Let me think. French and Saunders. I was going.
I won't ask who's who.
Probably best not to, eh? So yeah, welcome, guys. I want to quickly just go through what we're looking at predominantly for the start of play today, and that's US inflation data. We saw PPI data out yesterday, came in on the slightly softer side, and there is, if you're looking purely on the feed through from pipeline inflation into the CPI number, I think there's a lag of about 3 or 4 months. But in terms of the significance of PPI yesterday, it plays into core PCE calculations. I think it takes about 20% of the of that, and it gets thrown into core PCE. So we'll have a look at that in a second. But the inflation data itself, we're looking for headline rate to rise to 2.9% from 2.7% year over year, according to the last analysis that I've seen. For the core CPI year over year, we're looking at 3.3. That would leave it unchanged. A note from Barclays here: they forecast the headline index to show a 0.36% month over month. They use unrounded numbers. 0.36% month over month rise, month over month. 2.9% year over year gain, reflecting a notable increase in gasoline and other energy prices and continued firmness in food. The bank said, we expect the core component to moderate to 0.22% on the month, 3.2% year over year, following a string of 0.3% month over month increases since August, almost entirely reflecting slower gains in used cars and other core goods prices. Nonetheless, we expect the core PCE price deflator to accelerate about 8 basis points in December to 0.19%, 2.8% annually, after folding in anticipated firming in components of PPI and import prices that inform the PCE reading. And on that note, Michael, what are your views on today's number, and do you see, do you agree with what we've just read from Barclays, or do you have your own particular view on it?
Yeah, well, firstly, good afternoon once again. I think the note you read out is pretty much spot on, to be honest with you. I think, clearly we're expecting a bit of a reacceleration in headline inflation, largely as a result of some temporary factors, although this rise in gasoline and energy prices looks to have continued into the start of the new year, certainly if you look at something like crude oil prices. What I would say just more broadly on CPI is I think the figures will probably largely just sort of strengthen the bias that we already had, which is one that we are slowly but surely getting back towards a more normal level of inflation, but it's a very, very bumpy path back to that level. And as a result of that, and when you throw in the blowout jobs numbers that we had from the States on Friday, I think that really just cements the case for the Fed to skip January and probably stay on the sidelines for a little while, just as they wait and see what the data says for the next quarter or
so in terms of normal, where would you see, what would you put normalcy at for inflation at the moment, stateside?
Yeah. Well, I think the way that I've kind of been framing it this cycle is we've moved to an environment, I think Ryan will probably agree with this, where 2% inflation is now a floor, whereas before the pandemic 2% was very much a ceiling. So I think really the central banks, whether it be the Fed, BOE, ECB, well maybe the ECB accepted, but certainly the Fed and the BOE would look at anything in a sort of 2 to 3% range on a headline annual reading and say, for now at least, that's probably good enough.
Fair enough. Ryan, would you concur?
Yeah, pretty much. The problem I have with inflation and what the normal level is, the core number has been above 3% for nearly 4 years now. So normalcy is already higher for that core number, and it is becoming a problem for the Fed. We've seen inflation going up the last couple of months. This will be another one in the pipe. It's already got the market obviously pushing towards a pause. It's got the Fed pushing towards a pause. And I think if we get a hot number today, if it's hotter than expected, well, we're going to start mechanically pricing rate hikes. You're going to see some of those metrics, forwards, futures, whatever, starting to price hikes. And we'll see the usual extremism of the pendulum swinging towards the hike side. And we've already had Bank of America saying that the cut cycle is over, and there's a strong risk that the next move might be a hike. So anything hotter, even if it's around expectations, is going to feed into that narrative. It's really going to take a real soft number, headline 2.5, 2.4, core under 3% for the market to change its thoughts about the Fed pause at the moment.
So just listening to what you're saying, you think we're looking at a more embedded inflation, a hot inflation read at the moment for the US at least, or if you say for the US, then you must say for other nations as well. But for the US, you think it's more embedded now?
Yeah, very much so, because they've got the economy to go with it. The difference between them and the Eurozone is the Eurozone's got a really weak economy. That's going to naturally bring disinflation, because if firms aren't making sales, they're going to cut prices. It's the natural order of things. But there's no indication that you need to do that in the US. And this goes back a long way. When we had that inflation spike, my thoughts were it's not whether inflation comes back down, where it comes back down to. And we're seeing this stickiness in the US. And as I say, there's more a case to see sticky inflation in the US now, perhaps even more so than the UK, and even more so than the Eurozone at the moment.
Okay, cool. So just open question. So this is more of a doom cycle in terms of what currently we're pricing less than 50 basis points worth of cuts to the whole of 2025. Considering where you were this time last year, when we were looking at rates already to be at a lower base than we are currently in the US. From the market perspective, and I want to always try and focus on market reaction to this. So we've heard from Ryan. Michael, do you see anything different in terms of a reaction or does the market take this in its stride and just go, you know what, this has been coming and it's as you were?
Yeah, it's a difficult one. I mean, I think that there's certainly an argument to say, this is all very much as we expected. No real need to react too significantly. I think what I would caution is, you think back to the jobs numbers that we had on Friday, and certainly in terms of risk assets, you look at the equity space, for example, and actually, the focus was really not on the fact that the jobs data was pointing to what is a solid US labor market and a solid US economy. It was really a focus all on the policy path and the implications that data would have. So I think certainly that the bias over CPI is probably one where actually you look at bond bears and you look at equity bears, and they're not really going to need too much by way of encouragement to step back into the market, particularly when you look at what's ahead. We obviously Q4 earnings seasons, inauguration day next week. Even if we were to get a cool CPI number today, are participants going to want to add fresh longs on the back of that, with that event risk on the horizon and in the knowledge that it probably won't shift the needle or move the dial too much for the Fed? I'd argue probably not. So I think you're likely to see a bigger move to the downside on a hot number than you are a rally on a cool number. At least that's the way I'm kind of viewing the balance of things.
Yeah, fair enough. Just looking then at the breakdown for I guess today's number, in the sense that, are there any hotspots? I mean, I think we're talking about airfares were particularly volatile area and feed through into core piece or into PCE numbers anywhere. Is there anything you're on the lookout for in particular, or just generally you're just trying to find anything that you can get a hook into to give you some sort of reading on this then, over and above what we've mentioned?
I mean, I think, let's keep it simple. Really, it's the headline metric, it's the core metric, maybe a glance at the super core metric, which is services less housing. I think we're probably past the point where we're digging, or at least where market participants are spending hours and hours digging into the data to try and explain away a beat or a miss. Certainly from a policy perspective, I don't think there's much of a focus on those kind of intricate details of the reports at this moment in time. It's very much a case of what is the direction of travel more broadly. There's always going to be a one-off factor that influences things one way or another. The one thing I would say in terms of PCE, though, is obviously we had that cooler than expected PPI number out of the US yesterday. Sorry to throw so many acronyms around here. But actually the components from PPI that feed into PCE were actually relatively hot. And I think that's one of the reasons why the moves that we saw on the back of the print yesterday actually faded in relatively short order. And I think, that's one thing to perhaps watch as the afternoon goes on and all the economists get their teeth into the data is, if the CPI number again points to what could be a relatively sort of warm PCE number at the end of the month, that could contain any of the positivity we might see post-release.
Yeah, fair enough. We're talking about feeding into prices. We have to look at, and it was mentioned at the top, the inauguration and the President-elect Trump's second term in office. We've talked about this before. We've covered, he's been covered infinitum, I guess. But it is now becoming closer. There is talk that he could bring up to as many as 100 executive orders in his speech next week. I've got a graph here from Barclays, which just showing the affected topic areas, I guess, that he's mentioned or people fear will be involved in any kind of early initiative from the new administration. Where do you see? Have you tempered your views about Trump and the tariffs and the inflationary aspect of that? I mean, I was talking to Jamie Dusher of PIQ last week, and he sort of said, look, it's more balanced than that. It's not all about the inflationary side of things. There, one thing will offset another in the initiatives he's trying to bring forward. Would you agree with that? Do you think that this is probably being over-trumped, if you like, in terms of the inflationary effect? Ryan?
My view hasn't changed. He's come in wielding the big tariff stick. 100% on Mexico, 200% on China, all this sort of stuff. The rhetoric is going to remain, I think, over the inauguration. His mindset is to say, I'm going to hit everyone really hard. And that effect is designed to bring them to the table. Whether that's what he wants to end up with at the end of the day is another question. He's a deal maker. So he's going to continue the threats. I expect him to continue the threats, like you say, 100 executive orders on the desk. He's going to say, I'm going to hit everyone with this, that, and the other, but not straight away. He'll probably put a bit of a deadline on it, and then that'll bring everyone to the table. And then he'll start negotiations, and there may be a few piecemeal tariffs going on here and there, big headline grabbing stuff. But he doesn't really want to do it. He'd rather get on with people and have decent trade deals. But he's going to continue that threat, I think, into next week. And then after that point, then we see what deals get done.
Yeah, it's interesting. I've got this piece here that, again, from this Barclays piece, it says, at a press conference at Mar-a-Lago, he refused to rule out using the military to gain control over the Panama Canal and Greenland, and said he would use economic force to make Canada the US's 51st state. Again, bold words. He also criticised former President Carter ahead of his funeral this week, classy, reiterating that his call for Hamas to release hostages and repeated the plan to drill, baby, drill. There's quite a lot to unpack in terms of what Trump wants to do, Michael. How seriously do you take all the threats and all the things he's saying at the moment?
Yeah, well, as you say, there's a hell of a lot to unpack, and actually, it seems to change minute by minute, day by day, with all of these anonymous sources stories, and all the journos trying to outdo one another in terms of who gets the most accurate exclusive. I think what's interesting is I broadly agree with the sentiments that Ryan just put across. I think the key thing is that everyone is kind of hoping and maybe assuming that Trump's bark is going to prove to be worse than his bite, and that actually a lot of this is just a negotiating tool. And certainly if the idea that was mooted earlier on in the week, whereby they were talking about potentially the tariffs being phased in over a period of time as opposed to just coming all in one go, again, that's an example of this being a negotiating tactic. But I think the problem with that is it's all well and good to kind of hope and feel like that's the case, but at the same time, everyone has still got a position and hedge for the potential worst case scenario, which is that we get blanket tariffs on everything on day one. And I think until you've got some clarity as to where between those two extremes the administration actually ends up falling, you are going to see sentiment very, very shaky, and probably a higher level of vol across the board. And I would stress that it seems unlikely that clarity will come on day one, perhaps even not in the first 100 days we get that clarity. I think this is a dynamic that participants now need to adjust to, where we are going to be trading by tweet or truth social post or headline to headline. There is not going to be a lot of clarity out there. And of course, if anyone remembers 2017, 2018, when the US-China trade deal was 90% done for about 18 months, you'll know exactly what I'm talking about in terms of how markets can chop around all over the place and be sort of buffeted by conflicting news flow.
Well, that's a good point. And we've seen ramifications of some of this in the bond markets over the past, since the start of the year, really, and the high yields we've seen. It's been covered, the US bond yield market's been covered, and they are a leading market, the 10-year space at least. But I want to sort of look towards Europe and the UK now, because we've had inflation data out this morning at the UK, but before that, preceding that, we have seen erratic bond moves, really erratic, one directional, but bond yields move higher since the turn of the year, and a lot of pressure on the UK Treasury and the Chancellor of the Exchequer, the UK's version of a finance minister, Rachel Reeves, blaming her and her autumn budget, for a lot of the misery that we've seen in the markets of late, and the sterling's decline. I know the answer to this. Where do you guys sit? And we'll start with Ryan on this one, with the UK economy, the UK monetary policy, and we'll take a look at the inflation data out today and GDP that's coming up later in the week.
Yeah. Well, as
Brian?
usual. Yeah. As usual, Mr. Bailey's in that position of being between a rock and a hard place. He's seeing sticky inflation, although he's got a bit of relief today. And then just when he thinks things are going their way, he's got the government borrowing shooting through the roof, making things difficult. So that's the problem with the UK. It's either really doing really well or it's doing really badly. There's no middle ground, it seems. We were speaking most of last year about UK exceptionalism, the pound doing well and economy holding up, and now it seems to have gone in a complete reverse. The problem for the government is the trust issue. If you lose investors' trust, you're in trouble. We saw what happened with Liz Truss, that episode, although there was the LDI factor in that. But if you lose trust, then in investors, then it's going to be a lot of hard work. We had this gilt auction this morning, and it went off 47 and a bit pips higher than it did in the prior one. That's a hell of a lot of extra money that they've got to find to pay off that borrowing on those interest rates. So while we've seen a little bit of a pullback in gilt yields, a little bit is nearly 10 pips today, that does give her a bit of fiscal headroom back, I suppose, but it doesn't bring investors flooding back into the UK. And so until they combat that, then you're going to have this pressure of money potentially flowing out of the UK while you're trying to get growth up.
But isn't some of this, and this is just trying to balance out, isn't some of this a global picture? Is some of this not the fact that we've seen yields around the world start to rise anyway, as the realization that we're not looking at multiple of cuts coming from the central banks outside of the ECB, for example? Is there not a bit of contagion there as well? There's just left. We're vulnerable anyway because of the points you make, but it's just exacerbated by that. But the fact is, it wasn't started in the UK. This was started with US 10-year yields on the rise as well.
Yeah, but we've been following that. All yields have been rising on the sticky inflation picture and what's going on with Trump and the US and whatever. But this leg in UK yields has only happened the last couple of weeks. It's been building because no one has been happy with the budget, and it's finally starting to blow, and investors are going, we can't trust you. I had this conversation with Michael last week. The fiscal headroom's gone, so they need to cut costs and potentially raise taxes again. Well, you buy yourself fiscal headroom, and if the market doesn't like it, it's going to eat that fiscal headroom again with yield. So it's a never-ending story. You've got to do something different, and I think unless they do something different and get proper growth measures going, the UK is going to be facing this doom loop, shall we say, at least in the early part of the year.
Michael, I guess you concur. You agree with that then?
Yeah, absolutely. I mean, this is a family program, so I'll keep things clean and say that I think we're in a bit of a pickle at the moment, really, here in the UK. And I mean, hindsight is 2020, as they say. But even at the time of the budget, we were all, every sort of commentator was sat around going, Rachel Reeves has announced all of these measures: tax and spend, borrow and spend. It's going to yield, I think the OBR's calculation was 1.5% extra GDP growth over a 50-year horizon, so next to nothing. And while doing that, she left herself about 10 billion quid's worth of headroom against the fiscal rules. So I guess in many ways it was only a matter of time as to when participants would kind of wake up and go, actually the numbers simply do not add up here. And that's exactly what we've seen. And I think you alluded to the sell-off across the treasury curve. I think that was probably a catalyst for investors to look a little bit more closely at the fiscal backdrop globally. And when you do that, the UK economy really sticks out like a sore thumb in terms of the perilous backdrop that we're facing here. And yes, we see gilts rallying this morning, yields coming lower after the CPI number, but to be honest with you, it doesn't really matter. We're still dealing with an economy that is stagnating at best. And also, even if gilts stayed at this level for the next few weeks or even couple of months, we're still at a level where the fiscal headroom has all but been wiped out. So I think the market is still gunning for the Treasury here in the UK, and really I think what we're going to need to see is either significant further spending cuts or further tax hikes. Not that I particularly want to see either, because they're only going to choke off economic growth even further. So Ryan, you rightly said that Andrew Bailey is stuck between a rock and a hard place. I think the government probably are as well.
There's plenty of room for them.
I mean, there's an FT piece this morning that says guilty investors have told the UK's Labour government that it may need to increase taxes further if it's to retain credibility with the bond market after its borrowing costs rose to their highest since the financial crisis. So there is a mounting pressure, not only on the government to do something in terms of taxes, but on Rachel Reeves herself. Is there much point in getting rid of her? Is there much point in her resigning and getting someone new in? The government's not likely to change its policy or fiscal stance right now, is it?
I think politically, the easiest option, if they do end up going down the route of tax rises, I think the easiest route from a political perspective is to throw Reeves under the proverbial bus, because you would be breaking your manifesto commitments at that stage, and that you would have that sort of sacrificial lamb and go, it was her that did it, not me. As this is Keir Starmer saying that, of course, we can try and move on. From a market perspective, if it's Reeves, if it's Starmer, if it's someone else, I don't think market participants care particularly much. I think the government at large has lost the confidence of market participants, and no matter who it is, it's going to be very, very hard to win that back at this stage.
Yeah, I think also the difference between the Conservatives and Labour is that the Conservatives would have been more likely to fold in such a scenario, whereas Labour is more inclined to double down, particularly a few months into their governorship. And Starmer's already been adamant Reeves is going nowhere, she's here for forever. And they will double down, raise taxes, to get that fiscal headroom, because that's what they plan. They can't be seen to go backwards this early on, and not 2 months after a budget as well.
No, fair enough. Right, we've got a couple of minutes left before we wrap this up. So bringing this back to the US and today's inflation read, again, after the softer data yesterday, from a market perspective, I know, Ryan, you're an FX trader, you look at the FX markets. What's your play, or what are you... you're not a short-term trader, I know that, intraday trader, but in terms of how you'd faced today's numbers, what would you be looking to do, or how would you approach the CPI read today?
Yeah, I think from a trading perspective, you obviously got to keep an eye on yields. I suspected after, and I said this before the NFP on Friday, I'll be cautious that we see on a good number yields moving massively higher. And they did go a bit higher, but then they sort of topped out. That was a gangbusters NFP number. We've had the PPI yesterday as well, which, while it missed expectations, the main numbers were still sticky or went higher. And again, yields, they firmed, but they didn't make new highs. I think the same thing with CPI. If it's a hot CPI today and we can't make fresh highs or hold fresh highs in yields, then that's going to indicate to me, at least from a trading Fed expectations, we've gone as far as we can in terms of a pause. It's going to take something super hot to get into that hike situation. So the market is going to be a bit more balanced. So I wouldn't be surprised to see a bit of dollar strength on hot numbers, yields rallying again, but I don't know if it's going to last unless it's stupidly hot numbers.
Fair play. Michael?
Yeah, I would very much echo that, to be honest with you. I think the key question is, how durable are the post-release moves that we see today? I think if we do get a cooler than expected CPI number and we see equities move to the upside, I would expect the profit to be taken on those moves in relatively short order. I guess the bigger question is, if we do get a hot number, how prolonged is any potential hawkish repricing that we see in the aftermath? I think they're the big questions for me, but overall I don't see today's CPI print as a huge game changer for the market or for the FOMC.
And yeah, just to add a final thing, I think pretty quickly after the CPI, if there's no big news, we're going to move very quickly to trading Trump's inauguration next week.
Yes, and that's going to be something to look forward to. As I said, potentially 100 new executive orders coming through from the president. So there's going to be enough really to chew on. And just a reminder for everyone, there is actually also a bank holiday Monday for the US because it's Martin Luther King Day over there. It falls on the same day, the inauguration. So again, there may be delayed gratification in terms of market reaction to whatever Trump says. Maybe it's a good buffer that he's not speaking as the markets are open because that could cause all sorts of issues in itself, I guess, and volatility. Guys, listen, thank you very much for your insights into today's inflation read and to the UK situation. If we had more time, I'd love to get into it a bit more and talk about the ECB and the Bank of Japan, because I think January is the end of January more is going to be a particularly busy time and potentially volatile time for market participants. So there's a lot to look forward to and a lot to sort of to chew out, I guess, is what we've got to say. So we'll have more programs on that in the near future. But thank you guys again for your participation. Always a pleasure having you two on. I love having you on together because I think maybe we'll get someone in the mix to argue with you two, but because you're too compliant with each other. But great words, and thank you very much for taking part.
Thank you very much, mate.
Thanks, mate.
Appreciate it. I'll put up the links to where you can find both my my guests and a link to this show is going up on all the social medias afterwards. So thank you very much, everyone, for listening. And yeah, happy trading. You got data out in 45 minutes. Just quickly recap on what we're looking for I close out, just to give you the estimates here. So CPI headline year over year expected to come in at 2.9 versus 2.7%. Last on the month, we're looking for a 0.4% rise from 0.3. Core reading on the year over year, we're looking at a 3.3% measure, which will keep it unchanged from last month. Month over month, we're looking for a core of 0.3, also unchanged. Data out at 8:30 Eastern Time, 13:30 GMT. Thank you for listening, and we look forward to having you again next week sometime.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.